Here with us today, we have John Lear, chief economist over at Morning Consult, and my Bloomberg opinion colleague, Allison Schrager. Um, so the number that's coming down the pike in just a few minutes uh, could be an interesting one. It comes against a backdrop of higher oil prices, obviously, renewed geopolitical uncertainty. Obviously, very, very tragic what has happened in Israel over the past week. And Additionally, we have this third factor of bond yields that have really spiked sort of from medium to longer durations, and questions about what that's going to mean for inflation going forward. So today's number, which probably isn't necessarily impacted by those factors, but is going to tell us a little something about momentum. The street is looking for, on the headline, a positive 0.3%. 0.3% on the core as well. So Fed's going to be looking at that one real closely. And then year on year, that would shake out as a plus 3.6% and a plus 4.1%. John, let me kick it over to you. Like, where do you think we are in the inflation narrative in the United States of America?
It was interesting to hear you sort of the preface, because there were so many, there's so much movement, I think, in markets and in the global economy that will not be reflected in this number that we're about to get. I mean, I do think we've experienced a lot of the easy disinflation. You know, it's easier to get from 9 to 5 than it is to get from 5 to 3. And so I think in many ways the easy part is kind of behind us, and what's left is really going to be the more challenging part. That core inflation number has been very persistent. And I think that's really the number that I'm watching pretty closely, just because energy markets are extremely volatile right now. Now, it is true that prolonged periods of elevated energy prices do have a way of sort of trickling into and affecting core inflation. But I guess I'm the 0.3, I think that's the right benchmark. And then there's probably going to be a lot of interesting insights underneath the top of the headline number.
Sure. What about you, Allison? How are you thinking about the narrative these days?
Pretty much the same way. I mean, I think, we'll really be coming off again the end of summer, which isn't going to necessarily probably follow the trends we've been seeing. Although I think it is interesting that some goods inflation is coming back when a lot of the sort of persistent part has been driven by services inflation. But as John points out, the coming months are going to be super revealing. Last year, we got somewhat lucky. While anyway, energy prices went up from war in Ukraine. It was a fairly warm summer, particularly in Europe. Winter. We'll see, now with more another crisis in the Middle East, energy prices could end up going even higher. And if we end up with a cold winter, I mean, I think that will be a sort of another headwind with inflation.
For sure. Yeah, and as always, right, it's about the interaction of both supply and demand. And I've become increasingly curious again about, what's going to happen with the dynamic with cars. I think in the short term, this is an important month because it's the month when the BLS updates its sample of used cars. So sometimes we see some volatility in that particular number. But in the longer term, too, that is a market that is a big chunk of the CPI and remains supply constrained and facing potentially additional supply constraints with what's going on with the UAW and so forth. So that could be a good one to watch. Maybe you don't want to overweight what happens from one month to the next because there's some funkiness about how the actual market feeds into the CPI numbers, but can't overlook it either. So we've got about 10 seconds until the number hits. So I'll bring that to you momentarily and give you a little bit of market reaction. But so we've got that populating, and so bang on number 0.3 on the core CPI month on month. The headline actually comes in a little hotter, which is a little bit surprising, but it might be sort of a rounding thing. So year on year, your headline CPI is 3.7%. The street was expecting 3.6%. But in terms of the year on year on the core, it ends up being 4.1%, exactly what everybody was expecting. I always say there's something good about predictability when it comes to inflation or anything else. I'll tell you what the market thinks of it. It's kind of like I'm looking at the 10-year yield right now, and it's just kind of wiggling around as it does as the algos try and figure out what they want to think. We're basically now we were kind of unchanged going into this report, and now you see the yield on the 10-year drifting up a little bit, and I'm not sure what that's going to look like when all of this shakes out. But like sometimes you get these whisper numbers on Wall Street, and I think the whisper was sort of suggesting that this was going to be a downside surprise, and it wasn't a downside surprise. But like taking a step back from all of this is like on expectations is my interpretation. So like coming back where you guys left off, John, I'll kick it to you. Does like a continuation and basically what we expected move the needle?
I think it's largely reaffirms kind of what we thought and what we discussed prior to this conversation. The housing number jumps out to me. That's been an area where we've had a lot of really persistent inflation, and I think folks at the Fed and others have tried to look through some of the anomalies of the shelter component of inflation, but it's there, and it's a very real. It makes up a meaningful share of the total basket. And if I take a step back and think about sort of disentangling some of the near-term dynamics from some of the longer-term dynamics, I think housing is an area where we clearly have some longer-term dynamics propping up demand, constrained supply. It's an area where I expect to see price pressures continue. In fact, we see that consumers remain fairly price sensitive in that area, that they're really concerned about elevated prices, and that affordability and availability are really big issues.
Yeah, and just quickly put some numbers on that. So the month-on-month change in the shelter component of CPI was up 0.6% on a seasonally adjusted basis. So we saw a bunch of 0.6s earlier in the year. But there had been some pretty dramatic slowing in this component. We were then seeing 0.4s, even a 0.3 in August. So we'll have to dig further into shelter itself. It also includes utilities and things like that. But 0.6 that can really move the needle in such a big component. To your point, Allison, what else jumps out at you here?
Well, two things that make me a little worried for the fall, which is a big source of the disinflation, which has been bringing it down, has been in both fuel and, as you point out, used cars. Both of which things have happened that wouldn't be in these numbers yet that might reverse those trends. I said, expect oil prices to go up. With the auto workers strike, we could expect used cars to go up. And I think we should always think that's important, because if you recall, when inflation broke out, everyone was obsessed with used cars and said, this is the only place where it's happening, so we don't need to worry. And I think that we've learned that this is sometimes the sort of indication something's getting worse. So I think the fact that we got so much disinflation from those two sources, and both those are vulnerable to sort of flipping, going the other way next time, should maybe cause us some concern.
Yeah. And sort of to that point, like we're seeing this uptick here, or this 0.3 month on month on the core, even as we got a big drag from used cars and trucks, right? Um, so to your point, if we run out of that drag, like what is gonna help us going forward? All right, so as this is shaking out, it doesn't strike me as a huge narrative changer. I'm looking again at the yield on the 10-year note, and it's basically up like 4 basis points on the day, which may have raised eyebrows in past years, but ain't nothing in the year 2023. So let's talk about some of the factors to look at going forward. And the first one I wanted to think about a little bit is energy, and like the sort of conventional wisdom among armchair macroeconomists and central bankers is that you always look through an energy shock. Oil prices have come up a little bit. People talk about a threat of that going further if the conflict in the Middle East were to escalate. If, for instance, Israel were to decide that Iran were directly linked to this terrible attack, and they needed to seek retribution, that could have major consequences for the oil market. But would that affect core CPI in a way? Policymakers, John? What do you think?
Yeah, I maybe am going to go a little against sort of maybe the common narrative, and I would say that it is likely to affect the narrative or affect the outlook, and I would say there's a couple reasons for that. So first, we saw yesterday, PPI is coming in pretty hot as well, and so I think those elevated energy prices are not only borne directly by consumers, but indirectly as feeding through producer prices. And over time, the one thing I hope most people have learned about inflation is that it tends to be super asymmetric. So really easy to go up, harder to come down. There's nominal rigidities that prices in general, particularly outside of the energy sector, rarely go down. And so once those elevated energy prices or energy costs are incorporated into prices, they're kind of set. And so I think you can see that in a lot of the, even in places like construction and manufacturing that are heavily energy dependent, those are all places that I think where we're likely to see sort of the persistent impact of elevated energy costs.
And I did want to ask you too. I've got a slide ready. Talk to us about the way that energy costs impact inflation expectations and the whole expectations channel. And let me while we're doing
that. Yeah, they're very
go
directly inversely related, and so we know that directly related, positively correlated, that as energy prices and gas prices in particular increase, that consumers update their inflation expectations and start anticipating out further into the future higher levels of inflation. I think that you're exactly right to describe this as the expectations channel, and that's something I think that the Fed has got to be monitoring very, very closely, which is to what extent so you can see here, inflation expectations are a proprietary measure of indirect consumer inflation expectations run in partnership with researchers from the Cleveland Federal Reserve, have been increasing over the last 2 months. They bottomed out at the end of July, and they've been increasing ever since. And I think, we had a mild retreat last week, but clearly consumers acknowledge that the easy gains have been won already, and that going ahead, they're becoming increasingly concerned about inflation.
And so is it fair to sort of describe the mechanism that we're potentially seeing play out in this graphic here, John, as like pump prices go up. Pump prices are the thing that the sort of inflation component that people experience kind of most palpably on a day-to-day basis. They then come to expect higher inflation in the year to come, and maybe that means they turn around and they go to their employer and say, look, you gotta take care of me this year because my expenses are going up. Even if that's not maybe like empirically 100% true based on their personal CPI, their psychological experience of this through the energy channel, maybe through the food channel, is we've got an inflation problem, and that ends up trickling through. Am I doing that
Yeah, I think
justice?
the only thing I would say that we have a paper just recently out showing that there's also sort of a propagation mechanism through social media. So it's not just people's direct expectations or direct experiences with gas prices. It's also indirectly via their social network of people who are experiencing elevated gas prices in their hometown. And so that's, I think, how this gets out of control very quickly, is that you can have network effects that kind of remove people's personal expectations from the underlying reality. And that's when things get really out of control.
Allison, do you have any thoughts on the energy situation, or you want to jump to bonds?
Well, I think you both said a couple things I think are worth highlighting. One is that, the energy situation brings a lot of uncertainty to inflation. And when we first saw the report, you said very quickly, oh, well, it's good to get things that you expect. And that is really true, because I think the uncertainty around inflation is in many ways as costly as a higher level. Like if you think about an asset that's more volatile, it's cheaper because it's considered, the uncertainty in your life is considered a great cost. And if you're going to the supermarket or you're going to the gas pump and you have no idea what you're going to get, in some ways, every dollar is just worth less because of that uncertainty alone. So I think that's one other way this sort of becomes very harmful and people are still unhappy with inflation, is the level of uncertainty everyone lives with. And I think we now have a lot more of that.
For sure. So another sort of piece of the puzzle here, I think, so everybody looks at these things and they say, okay, what does it mean for the Fed, right? Is the Fed going to go higher? How long are they going to stay here? Are they going to stay where they are? And the other sort of piece of the puzzle here that's really become a prominent feature of Fed speak in the past couple of weeks is what's going on with longer term bond yields. And the story basically is the short end of the Treasury curve has done over the past year and a half what you would expect it to do, which is basically follow the policy rate. But the longer the yield curve, it basically, call it from anywhere from five years forward, and a lot of people like to look at like the 10-year as a key benchmark, stayed remarkably low and remarkably inverted for a long time. And we could sort of quibble about why that was. Some people say it was because consensus thought that a recession was imminent. Some people would say that consensus thought that transitory inflation, was always going to be a thing. But for one reason or another, the yield curve has looked funkier than it usually does, and longer-term bond yields were low. And now, for some reason, again, we can argue about the catalyst, but that has changed, and we are now kind of in the space of just about 8 weeks, let's call it, looking at 10-year bond yields, nominal 4.61%. That was a whole 100 basis points lower back in the middle of July. Does that, you think, do some work for the Fed in terms of restraining demand in this economy and helping fight inflation? Maybe not bringing down reported inflation in the Bureau of Labor Statistics October number, but as we look 3 and 6 months out, is this potentially doing the job of covering the last mile that John talked about earlier in this tricky inflation?
I don't know if it brings you the last mile, but it certainly helps. A lot of sort of interest rates that consumers face are based on the 10-year. So, in a lot of ways, that does do a lot of the work. And I think the slowness of the fixed income market to wake up to our new reality is one of the reasons why it took so long for it to go up. I think everyone was surprised it hadn't done it sooner. So it should, as I said, impact consumer credit a lot more. Although it's hard to imagine mortgage rates going even higher. Although mortgage rates typically are based on the 10-year. Although I think that was largely because of the spreads and the fact that the Fed was before interfering a lot with the mortgage-backed security market and then stopped. But so yeah, I think this will do not all the work, but some of it.
All right. What do you think, Sean?
Well, I think my guess is that folks sitting in, at the board or elsewhere are saying, okay, finally, we have some credibility with financial markets, that this is kind of what they've been saying for a long time. And to Allison's point, I think it's been surprising how long it's taken for folks to accept that higher for longer does in fact mean higher for longer.
Yeah. And how should we think about this, like in the context of financial conditions? Because, like, to me, like when I see this 10-year shoot up, and I see mortgage rates shoot up, it's like a very, very visible number that impacts us all directly. This feels like a lot of financial conditions tightening that we're seeing right now, and yet, like the popular indices that try to capture the soup that is financial conditions are not necessarily reflecting as much financial conditions tightening. They tend to focus on things like spreads. Some of them will include different measures of risk, including equity markets. And they're saying, yes, we've tightened a little bit. We haven't tightened a lot. Where do you guys stand on financial conditions? And like, does this feel like it's tightened a lot? Is it tight enough to achieve the Fed's objectives here?
I think this is a very, very strange market. Just because, I mean, we had such low rates for very long, like historically shocking, like near zero rates. And so what we had was we had a lot of consumers and we had a lot of corporations lock in those low rates. Yeah. So what we're seeing, and that's unusual. Normally when we study, how people respond to higher rates, you don't assume everyone's locked in a zero interest rate for as long as possible. So, and I think we're just seeing something we've never really seen before where, in some ways, maybe this will be better because the pain will be more doled out more evenly over time. There won't be this one day where everyone refinances and it's like, oh no, rates are much higher than I expected. Or it just could mean that we're delaying and we're going to end up with more pain in the future. I'm not sure, but I think it's just, rates going up now doesn't seem to do as much just because the pain's not going to really be realized until 2025.
Gotcha.
I mean, just maybe 2 quick points there is like, coming out of the financial crisis, right? We have so many more fixed mortgages than we did prior to the financial crisis. So that channel of higher interest rates affecting consumers is slightly muted. And then I just want to underscore and double down on Allison's point that, we're coming from a spot where interest rates were near historic lows. In fact, the challenge was we couldn't get them low enough, and we were trying to figure out how to bring down longer-term inflation expectations. And so we're just now, I think you talk about financial conditions, we're just now entering a point where real interest rates have been positive for some time, and I think that takes a little bit to funnel through, particularly as you start getting corporations and consumers to start refinancing.
So I did want to. Allison was saying in the pre-show that she liked to get nerdy, so I wanted to get a little bit nerdy here and dig into the core CPI number while I have these two great this screen that I brought up right here is basically showing what's going on in core CPI, just breaking it down into the two most fundamental components: commodities x food and energy commodities, and services x food and energy. Right. So the intuition here, the takeaway of this month's seasonally adjusted month-on-month core CPI number is that it's all about services, right? All about services. You're still, as Allison, this is a point that Allison made earlier, you're still getting significant drag from core goods, in large part those used cars in this case. So what we kind of need to pay attention to and dig in here is that core services category. So I'll dig in further. So we go into core services, and then within within core services, all again about that shelter number. This was a huge bump here, and without it, we really wouldn't have much of an acceleration at all in that overall core CPI number. So the point of this exercise is I really wanted to get inside this one and see what's doing the damage on shelter, and it is actually okay. So let's see here. So we had rent of primary residence was basically stable. The big swing, really big swing, was lodging away from home. I wonder if we don't have to worry so much about the stickiness of that particular one, but lodging away from home, the swing we may be seeing was potentially like a quirk of August. So in August, lodging away from home, the month on month showed deflation, and then in September, you had a big swing in that lodging away from home sort of reverts to a fairly strong number. Owner's equivalent rent also accelerates to a somewhat meaningful degree. It contributed 0.3 in August, and it ends up contributing 0.4 in September. So like that's kind of weird. I don't know about you guys, how you guys feel about throwing things out, but like I would tend to throw out the lodging away from home thing because it's been all over the place, very herky jerky in the last couple of months. I would want to know why the contribution from owner's equivalent rent went up that much. I think that's sort of the enduring question that I'm gonna be digging around about.
My only caveat there is it has felt like for the last, I would really say since the start of the year, that folks who sort of believed in the immaculate disinflation theory have done a great job of changing the categories that they throw out from month to month to tell that story. Yeah, and so so I think this is valuable as a decomposition. It's it's sort of an arithmetic decomposition of the drivers of inflation. I do think this is why I think Jason Furman has got a great approach to this, where he selects 10 different versions of inflation, dropping different categories, and you come up with an average from that, which I do think that's kind of the right approach, which is any one month there might be idiosyncrasies in the data, but the top line takeaway is demand is still really strong relative to supply. It might bump around, but that's, I think, there's a risk of really trying to read into this data what you want to get out of it.
100%. Allison, you in the same camp?
Yeah, because I think one thing we learned, I remember in the early days when people were really into picking out like used cars and saying, well, if we take that away, we have no inflation, is, what economists are trying to explain is like, consumers like don't care. They have this whole basket of goods that they have to consume. And the fact that they have to pay 5 times as much for a new car just means that they're facing higher prices.
Yeah, agreed. All right. I feel like I've been tisked a little bit, so I zoomed, I zoomed out, and this is a different view and an easier to digest decomposition. So this is headline CPI presented year on year, so it may be a little bit less dizzying. And in the yellow, what you're seeing is services excluding energy services. And so this is all a little more intuitive, and it's giving you sort of a better idea of what's happening in the longer term trend. Longer term, the bottom line is energy is still a bit of a drag if you're comparing to 12 months ago. Food is kind of normalizing. Commodity is like you can't even see the purple commodities bar in here and anymore. And as Jerome Powell has been saying for a long time, the key question is sort of like using policy to get at the sticky categories that make up core services and are heavily influenced by wages and things like that. We're winding down here. I want to give you guys kind of the last word. I think that I'll give everybody a market check too before I kick it back over to you. But this feels like kind of a mellow report. I'll come back to what I said at the outset. I'm always glad to see that the models are working and that people don't have to open their Bloomberg terminal or their Wall Street Journal and feel whiplashed by a complete like 180 in the narrative when as they digest these inflation numbers. This feels basically as expected. Bond market is reacting more or less as expected. We're up 3 basis points on the 10-year note yield, which really isn't much considering the volatility that we've seen recently. So what will be your takeaways and the questions you think that you want to try and answer over the months to come here?
Well, as I think this is good progress. And as you say, it's important that you get what you expect. And I think there's a real value in that in of itself. But I guess the question is now that all these shocks we are faced with that haven't been shown up yet, what that's going to mean. If in the next couple of inflation reports, we're still following this trend, then I think we could sort of say this is a very sort of robust trend, or we'll know if this is going to be like we're heading towards another 70s repeat of, inflation quiets and it gets worse, it quiets, it gets worse. So we'll find out.
Yeah, I would double tap that one of the risks that we have is, it's sort of like taking your medicine. If you don't take all of it at first, I think actually the disease has a potential to be slightly longer and manifest itself in different forms. So that's really the risk, I think, from the policy perspective, is making sure that this is tamed in a timely manner. And maybe the pushback to the narrative that we hear from the Fed is that this sort of ongoing disinflation story assumes that they have another 12 months to get it under control. It's not clear to me that 12 more months of this is not going to, that we won't experience some other shock. And it feels a little bit like we're in the middle of that right now with energy combined with labor, the strike, potentially good shortage. Those all have the potential, again, I think, to contract supply and to present a real headwind to monetary policymakers.
All right. Well, let's leave it right there. John Lear, Morning Consult, Allison Schrager, Bloomberg Opinion and Manhattan Institute. Thank you both for being here. Thank you to everybody who listened in. Have a good day, everybody.